I started investing when I was 11, though I had been playing around with ideas for a few years before that. At that age, I bought my first stock and started experimenting, timing the market, reading charts, trying out all kinds of theories. It gave me a clear framework to think about. Investing built around 3 key principles. You need to understand the business, what it sells, who its competitors are, what kind of management it has. That's more important than knowing the ticker symbol or watching the stock price every day. It wasn't profitable, but it was fun. I kept at it until I was 19, reading every investment book I could find in the public library. Then I read The Intelligent Investor by Benjamin Graham, and that changed everything. If you stick to them, you don't need anything more complicated. You do want something with a durable competitive advantage, something with a moat around it that protects it from competitors. The first principle is that a stock is a piece of a business. It's not just a symbol on a screen. No matter how much money a rival spends on advertising, they won't replace that emotional connection. That's a moat. The second principle is how to respond to market fluctuations. If you make 20 solid investment decisions in your lifetime, that's enough. That's why I sometimes say students should have a punch card with only 20 slots, to force them to think carefully before each investment. The best businesses are so strong that even an average person can run them, because eventually, someone will. Graham introduced the idea of Mr. Market, an imaginary partner who offers to buy your shares or sell you more every day, but at wildly different prices depending on his mood and as capital grows. That focus becomes even more important. He's emotional, unpredictable, and often irrational. Your job is not to follow him, but to take advantage of him only when it suits you. The stock market is full of extreme price swings. Solid American companies can see their stock prices double or get cut in half in a year, even when their actual business hasn't changed much. If you're driving a truck that weighs 9,800 pounds and the bridge says its limit is 10,000, you don't cross it. You find a stronger bridge. In investing, you don't want to cut things close. You want to leave room for error. That doesn't happen with farmland or apartment buildings. So you can wait for the market to give you a great opportunity. You don't have to act every day. The third principle is the margin of safety. Those 3 ideas: think like a business owner, ignore the market's emotions, and insist on a margin of safety, form a powerful foundation. Now imagine you had to buy 3 private businesses in your town and hold them forever. What would you look for? Billions of people know the brand and associate it with happiness. Take Coca-Cola. You also want honest, capable managers. And, of course, you want to pay a fair price. The key is not to act all the time. And as capital grows, that focus becomes even more important. That's how we think at Berkshire. We look for big, meaningful ideas, not small trades.